Do you want to get into the stock market without having to do the research on each individual stock? Or maybe you want to diversify your portfolio but don't know which industry to invest in? Then I think a mutual fund is what you need. In today's fund, I'll give you all the basics on mutual funds. Hey, it's Cash from Lehman's Investing, where we give you the basics on investing to become one step closer to financial independence. If you enjoy content like this, like, comment, share, and subscribe. A mutual fund is a company that pools money from other investors to purchase stocks, bonds, and other assets. Mutual fund investors don't directly own the stock or other investments held by the fund, but they do share equally in the profits or losses of the fund's total holdings. Mutual funds are a hands-off way to invest in many different assets at once. With one mutual fund, you can gain exposure to hundreds of stocks and bonds. There are generally two types of mutual funds, active and passive. A mutual fund's fees and performance will depend on which category it falls into. Passively managed funds try to match the performance of a market index, such as the S&P 500, and therefore typically don't require management by a professional. This means passive mutual funds often carry lower fees than actively managed funds. There are two types of passive funds that are popular to invest in: indexes and ETFs. Actively managed funds have a professional manager or management team making decisions about how to invest the fund's money. Often they try to outperform the market. If you contribute to a 401k, there's a good chance you're already invested in a mutual fund. But if you're ready to invest in a mutual fund, separate from your employer, you should consider a few things first. Decide whether you want to invest in a passive or actively managed fund. Next, decide your budget. Many mutual fund minimums range from $500 to $3,000, though some are in the $100 range and even a few that have a $0 minimum. Whether you choose active or passive funds, a company will charge you an annual fee for fund management and other costs of running the fund, expressed as a percent of the cash that you invest. This number is known as the expense ratio. For an example, a fund with a 1% ratio will cost you $10 for every $1,000 that you invest. So how do you make money with a mutual fund? When you buy into a mutual fund, your investment can increase in value in three ways. One way is dividend payments, which is when a fund receives interest from securities in its portfolio. When purchasing shares in a mutual fund, you can choose to receive your distributions directly or to have them reinvested in the fund. Secondly is through capital gains, when a fund sells a security that has gone up in price. Most funds distribute any net capital gains to investors annually. And lastly is through net assessed value. The price per mutual fund share is known as the net assessed value, or NAV. As the value of the fund increases, your share in the company increases, meaning if you sell your share of the company, then you'll sell it for a gain. Down below are some suggested mutual funds we found. There are many more than just the ones that we've named here, and the results vary generally between 10% and 12%. So now you know all the basics behind mutual funds and how to invest in them. Make sure you do the extra research on the funds you want to invest in and the fees that come along with managing them. As always, thanks for watching, and subscribe, like, and comment if you want more content like this.